You are listening to Keystone's Stock Talk Show, episode 298.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to chat with you again this week. Our star of the week is professional services and project management company AtkinsRéalis Group, symbol ATRL on the TSX, which specializes in engineering services and the nuclear field. The stock jumped 16% this past week after reporting strong Q1 numbers, and I will let you know if the company is a smart way to play the potential resurgence of nuclear power. In our Your Stock Our Take segment, Aaron kicks it off with a look at Home Depot, with the world's largest home improvement retailer releasing Q1 numbers today. He'll take a look at them. Brennan revisits Jessica Alba co-founded personal care company, The Honest Company, giving his honest opinion on the valuations of the business. Last and not least, Brett answers a viewer question on SolarEdge Technologies Inc., symbol SEDG on the NASDAQ, a dog of the week in late 2024. After cratering from highs, the stock is up 41% year to date. Is it sustainable or a dead cat bounce? Brett will let you know. All right, let's get to the show. I'm going to welcome my co-host, Mr. Aaron Dunn, and the Killer Bees, Brett and Brennan. How are you guys doing? How was your weekend? Anything new?
Doing well.
Doing good. Long weekend, so always nice to have that. And
always a party.
Lots of work always waiting when we get back. On Tuesday.
Brennan tied one on, let's be honest. Did you?
No,
maybe
I did. But no, my friends did have a little bit of a party, did some golfing this weekend. It was unfortunate that the Oilers weren't playing this weekend, and which brings me to, I thought
it would be good if they were never playing again.
I actually thought that
the Canucks,
what we would do, or what I would do, just given Ryan's disappointment with the Vancouver Canucks, I thought that I would start filling out a bandwagon transfer form for him. So I got it up on the screen here. You can take a look at it. And realistically, I think that, he does have some bandwagon history, where last year he was actually cheering for the Panthers when they were against the Oilers. But I think this year we can convince him to cheer for the Oilers.
Not an effing chance.
Still managing? Isn't Luongo still managing the Panthers?
This is the Oilers we're talking about.
No, but he was saying the Panthers. You were cheering for.
Oh, I didn't even hear. I just tuned it out as soon as he said that. Sorry, that literally tuned it out. Whatever you were saying about the Oilers.
Ryan hears Oilers
the
and
steaming Coilers, and it's over.
Yeah.
Not knowing what I'm talking about.
Look, I'm scarred from watching. We had seasons tickets in my family, and in the 80s, and the Oilers used to come in with Gretzky, Messier, Curry, Anderson, all those clowns, Coffee, and they would literally beat the living crap out of the Canucks over. Like it was. They were skating. They could have been figure skating around on the ice. Honestly, it was just ridiculous. Skating circles around them. There was literally 12-2 nights, and there's no way I could ever be a Coilers fan, particularly with the way this team was built. I mean, it's amazing to have Draisaitl and McDavid, but if the Canucks did suck that long too, but they just didn't get any lottery luck, and the Oilers have had literally 65 first overall picks, and finally came up with a team out of pure absolute suckery. They came up with this team they have now. So impressively done, Edmonton. Thank you. I'm just pissing off everybody from Alberta.
Didn't Vancouver get lost in the league the first year that?
Because you can't win a number of. It's 2 years after 2 years, because they had won several years within a period of time. It's 5 years or 10 years. You can't keep winning the lottery, but I mean. You know what? Fabulous players to watch. Mike McDavid, Draisaitl. They've got more depth there. Goaltending would still worry me, but built on absolute suckery. It doesn't impress me.
Anyways,
and
I
at
just
least
wanted
the
to get
Leafs
you
are
on that
gone. That's all.
tangent.
We can all agree on that. The Leafs
Wow,
are
whoa,
out.
whoa. I don't know about that.
You're angry. The
Somebody
Leafs are
sounds
gone?
angry.
Well, I mean,
Somebody
I don't know
sounds
if I'm
maybe a little
angry,
jealous.
but I think a lot of our listeners will be angry at that comment.
Yeah, everybody hates.
They're
Leafs.
unsubscribing
Even Leafs
right now.
fans. Trust me, right now, the Leafs fans even hate the Leafs. Trust
That
me,
is
right now.
that is fair.
Oh,
I heard. I saw
is
Drake throwing around
vitriol.
the Bieber curse because Justin Bieber was behind the Leafs bench there, and I saw Drake throwing around that it's the Bieber curse.
Yeah,
that's
definitely.
why they lost.
It's definitely Bieber's fault. That's what
Yeah,
it is.
it's
Not
Bieber.
the fact they haven't had a defense good enough to win anything in years. Anyways, let's go. Let's move on.
Yes.
There's a poll question we have, right? And it doesn't have to do with hockey, I heard.
No,
right?
it does not. No.
Okay.
So surprisingly with you,
I know.
It doesn't. One of two Ryan's loves in life, finance and hockey.
Mm-hmm.
This one's to do with finance, luckily.
Yeah.
So, simple question: how much of your total investment portfolio is stock/equity? 74% of our viewers said 100% stocks and equity, so no fixed income, no GICs, no alternative assets. Then 21% had the classic, or more than the classic 60-40. So 6% stocks and equities, but less than 100%. It was 20% of our viewers. 4% of our viewers had less than 60% stocks, and one voter, or 2%, had no stocks or equities. I want to know who you are, and maybe one day we'll get you to invest in some
Post
sort of
below.
stock.
It was not me.
Brennan.
It was not
below.
me.
Go down. He cleared out his account. I'm surprised. So it's such a high. I mean, obviously, this is a select group, people that follow the Stock Talk podcast, but that's a high number of people that don't have any.
Yeah, 74%. Yeah,
74%.
Yeah, like I fell into the less than 60%
Right.
stocks and equity, but more than 0%. So like I'm like 50-50 roughly. But again, it depends on your personal circumstance. I want to buy a house. Listeners are probably sick and tired of me talking about me wanting to buy a house. But I'm just trying to maintain the liquidity.
Saskatoon market.
Well, they better get used to it because they're going to be hearing.
Yeah,
If my
well,
math's
maybe
correct, I own 120% stocks. That's what my math says right there.
Yeah.
So you're leveraged.
You're levered
already.
up.
No, I'm kidding. I'm kidding. No, obviously I have some fixed income. Yeah. But yeah, it would be in the more than 60 in this range.
Yeah, I'd be the same there.
Even despite the fact that I am older than 60, I have more than 60%. It's crazy.
I don't know. That bandwagon forum was saying something about you being a millennial, or close to a millennial. So I don't know.
It's so wrong, but all right. I think we can move on. Is there anything else you guys wanted to look at in the markets, or should we get right to it? We've got about 4 companies to cover today, so we should probably just start taking a look at those. I am going to start off with a company that I like to call SNC Lavalin, but they rebranded themselves for pretty good reason. But it's AtkinsRéalis Group, if I'm saying that correctly. AtkinsRéalis Group Inc. Symbol ATRL on the TSX. Trades around $88, almost $89, $15 billion market cap, very small dividend yield right now. But what does the company do? Founded in 1911, AtkinsRéalis is a fully managed professional services and project management company specializing in engineering services and the nuclear field. The company offers a broad range of expertise spanning consulting and advisory, intelligent networks, cybersecurity, design and engineering, procurement, project and construction management, O&M, decommissioning, and sustainable capital. That's a lot. They offer a wide range of services, and this is where the company is getting a lot of attention today in the nuclear industry, encompassing the entire nuclear life cycle from design and new build to decommissioning and waste management. The company is a significant global player in nuclear technology, particularly with the CANDU nuclear technology. AtkinsRéalis acts as the steward of this nuclear technology, operating on 4 continents. Now, CANDU was developed by the Atomic Energy of Canada Limited, or the AECL, a Canadian Crown Corporation. The development began in the 1950s through a partnership with Ontario Hydro and the Canadian General Electric Company. While the Atomic Energy of Canada Limited initially developed and marketed the technology, it later sold its reactor division to then SNC-Lavalin's CANDU Energy subsidiary in 2011. CANDU is still owned by Atomic Energy Canada, but they have a memorandum of understanding with AtkinsRéalis, kind of a quasi-licensee. But why is this company our star of the week? Well, it nearly jumped 17% in the last 5 days after it reported strong fiscal year 2025 Q1 numbers. You can see the stock is also up around 68% over the past year. Let's take a look at those strong numbers, which are driving the stock higher. Services revenue totaled $2.5 billion. That's about a 15% increase. 10.1% of that was organic, which is very strong. Engineering services regions revenues were $1.7 billion. That is just an increase of 1%. That's actually a decrease of 3.8% on an organic basis. It's the nuclear revenue that is driving the results here. They were up 80% in the quarter, 76.9% on an organic basis. The company's Linxon revenue also was up 40% in the quarter as well. Adjusted net income from PS and PM increased 36% to 57 cents per diluted share, up from 42 in the same period last year. And the services backlog was up significantly, 32.2% to $20.2 million as at March 31st, 2025. Backlog for engineering services, nuclear, and its Linxon all reached new record high levels, significant increases that we saw here. Let's quickly look at the balance sheet. About $435 million in cash in the bank. Debt is $2.19 billion. Net debt to EBITDA is about 1.1 times. The outlook, the company raised its nuclear revenue outlook in the quarter for full year 2025 to between 1.9 and 2 billion from previous range of 1.6 to 1.7 billion. So relatively significant. It reflected strong growth year to date and confidence in demand continuing over the balance of the year, supported by record backlog. Management also adjusted its nuclear segment adjusted EBIT down slightly to segment revenue ratio outlook for the year 2025 to between 11 and 13% from the previous range of between 12 and 14%, reflecting a different expected business mix. Let's take a quick look at the valuations here on a price to adjusted EBITDA basis based on its 2024 actual results. It's about 50 times. Price to adjusted EPS based on expected numbers this year. Expected adjusted EPS this year is about 33.9. Price to adjusted EPS on 2026 expected numbers is about 26.9. So premium valuations, but again, we saw the backlog up significantly over the past year, so that earnings growth and backlog will support higher multiples. It has to continue, of course. Conclusion here, overall, the Q1 results were ahead of consensus forecast relatively significantly, and the company revised its 2025 and 2025 to 2027 nuclear segment expectations higher for the most part. The company's backlog reached a new record high of $20.2 billion. Again, that's 32.2% year-over-year increase, with nuclear at a record high of $5.2 billion. Recently introduced 2027 financial targets that includes 2025 to 2027 engineering services organic revenue compounding annually at greater than 8% and a segment adjusted EBITDA margin as a percentage of segment net revenue of 17 to 18% versus 15% we saw in 2023. And nuclear revenue of between 1.8 to 2 billion, midpoint of the range implies about 16% compound annual growth from 2023 to 2027, and a segment adjusted EBITDA margin as a percentage of the segment revenue at about 12 to 14% versus about 13.9 in 2023. So it is a reasonable option to gain nuclear exposure. Again, you're paying premium multiples on the stock in the near term, and there are some disclosures. Any comments from anyone?
Yeah, it's interesting because if you look back on this company, I mean, obviously, as you said, it's had a checkered past. Formerly was involved in a lot of controversy in terms of I can't even remember what it was. I believe it was bribery of officials in developing countries, just a lot of stuff like that. But the stock was really under fire for a while there. This is back when it was S&C. But I remember the valuation being, quite reasonable for a time. And a lot of that was because of all of the underlying uncertainty and risk with it. But I seem to remember it being, kind of in the mid teens.
Yeah. And there's a significant restructuring that's gone on. And to give you an idea, like 10 years ago, December 2015, they had 9.5 billion in revenues. Now they're just at 9.9 billion on a trailing 12 months basis, but they got to as low over the past 10 years of about like 7.3. So if you go back to 2021, went from 7.3 to 7.5, then 8.6 and 9.6, and now trailing is 9.9. So the trajectory over the past 3 years, for example, has really upticked in terms of revenues, and it is the operating income and profitability that really has upticked, and that's what's driving the stock higher. Plus, people want to gain, like we were saying, exposure to the trend in nuclear. If we're having a resurgence in that, it's difficult to buy a profitable, company that is processing or producing in that segment that's consistently profitable. So this is kind of a backdoor way of playing that, and there aren't a lot of options in that respect. And this company, leads as one of the leading technologies in that field. It was developed in Canada, as I kind of went through there. And, this company has recently signed significant contracts internationally, and there's more countries around the world now making noise of, pushing forward with nuclear power options versus, it was basically blackballed for decades. So, yeah. And I mean, there's risk there, but, the efficiencies in nuclear is far greater than some of the other technologies out there if we can just find a way to deal with the waste and the risks.
Yeah, I would say we've really seen like a step back from like the true 100% like renewable shift where people were like, oh, we're going to drop oil. It's all going to be solar and wind, and nuclear has really come out past probably 3 or 4 years now. Investors just want a piece of it, and there just really isn't that many good public investment tools. So it doesn't surprise me.
This is one of your ways.
Yeah, and we've seen just the valuation, like Aaron was saying, is it used to trade a lot cheaper. But even with fundamentals being improved over the past 3 years, we've seen the share price well outpace the improvement in fundamentals. Just the valuations expanded as a result.
Yeah, which is something you have to keep an eye on. I mean, you want to get exposure, but you don't want to pay anything, obviously. So that, that's what we would keep an eye on in the stock. It probably, if you could see a pullback, that might be a time that you might want to look at it if you want exposure. But, I did look on a price to cash flow basis. It is trading at, the higher end of its range. Now, it's really skewed because there were times where this company was losing money over the past, 10 years. But it's not expressively overpriced right now if they can continue to grow. Like when you see backlog up 32% and a backlog of that size up, and if they can deliver profitably on that, but you were able to purchase this company at a significantly lower multiple to cash flow many times over the past decade. There were many reasons for that, and it looks like a far better company today, but we just have to continue to watch the company because it has had a volatile history, certainly trending in the right direction. Fundamentally right now, do you want to pay that premium price? That's what you have to ask yourself, and it has to keep growing to keep that price. All right, let's move on to our next segment. I think we have Aaron talking about the largest retailer in the world, or home retailer in the world. It's Home Depot. Brennan thought it was Rona, but it's I had to school him today and tell him it was Home Depot.
I thought it was PV Mart.
Yeah, well, they gave you your job, didn't they?
They did give me my first job, yes, and unfortunately, they just recently went out of business.
Okay, so yeah, my pleasure, Ryan. We're going to take a look at Home Depot. This is a company that everybody, I'm sure, has bought products from many times in their life. Certainly, if you
I was there
have done
this
any
weekend.
work on your
Yeah.
house,
I
you were there
bought
this
some
weekend.
soil.
I was there not too long ago, and we all know the brand well. Big U.S. company. So Home Depot is the world's largest home improvement retailer. They have 2,350 big box stores in North America. Symbol is HD. The price is $378, $340 billion market cap, and a 2.4% yield. It is also a dividend grower as well. So the company has it's been volatile with the overall market over the past year, and then also year to date. So year to date, the stock price is down about 2.5%. This is versus the S&P 500, which I believe is now up 1% for the year. Although I have to check on that because it changes so quickly, even just throughout the day. But fairly typical share price activity here from Home Depot. The company did just release its Q1 financial results and updated its guidance. So we're going to take a look at those results. One of the reasons why I think that Home Depot is an interesting company to look at right now, everybody's looking at the Q1 results from the lens of how are tariffs impacting the financial performance of companies? How are they going to impact prices? How is consumer spending and any declines there having taking its bite out of performance? So far in Q1, I think that we're just starting to see some of the effects trickle in, but it is interesting to see or hear what the management commentary is from some of these companies, just in the context of the macroeconomic picture and all of these tariffs and uncertainty. But looking at Home Depot's Q1 results, net sales $39.9 billion, up 9.4%. Comparable same-store sales were actually down 0.3%, although in the US they were up 0.2%. Adjusted EPS $3.56, down 3%. They missed analyst estimates by just a couple of cents. I believe analysts were estimating about $3.60, $3.62 in earnings. Gross margin down 70 basis points, primarily due to foreign exchange. And then operating margin was down 120 basis points in the quarter. So in terms of management commentary, what was management saying about the results and just the overall environment? Well, very interesting is that they're actually saying, the CEO is saying that they will not raise prices to offset tariffs. So they're making this commitment. I know that some companies are already starting to raise prices. Some are being very vocal about the reason why and highlighting that it is in fact tariffs. But Home Depot is saying, at least for now, that they won't. We will see. I mean, really, this is a promise that you can't make. It really depends on how badly tariffs impact the company's costs. We don't know what the tariff structure is going to be in 6 months or a year from now. It all seems very chaotic. So there are scenarios where if they don't raise prices, they would essentially be losing money to be in business. And I'm sure they're not going to do that. So, but looking at their targets, over 50% of their sourcing, they say, is in the US. They're targeting less than 10% reliance on any non-US country by next year. Some of the opportunities that they're highlighting just in terms of future growth, expanding the size of the company in terms of new store openings, looking at 13 new store openings for 2025, omni-channel investments as well, essentially expanding channels, so more online, more partnerships, and then more stores. Now with 2,530 stores, obviously adding 13 a year is barely moving that needle, but it all helps. And typically when you're adding new stores, you're adding them in areas where the profitability is probably going to be higher than the average in your existing portfolio. Now, in terms of headwinds, a few of the things that the company highlighted were just the cooler spring weather and higher interest rates as well, slowing down the large renovation projects. So they've noticed that. In terms of macroeconomic conditions, we also do have to take into account that this is a market that does have cyclicality in it as well. If people don't feel confident in their job, if they don't feel confident in their income, and as well if interest rates are high, they're going to be far less likely to do renovations and upgrades on their house. So that will affect the company depending on how the economy trends over the next several quarters. Now, looking at the balance sheet, total debt 51 billion, net debt of just under 50 billion. And I have a net debt to EBITDA multiple of 2.4 times. So I think that is a perfectly healthy debt leverage ratio for a company like Home Depot, particularly brick and mortar, where you would expect there to be some debt because it's a capital intensive business. Now, guidance and valuation, what are they looking at for next year? So this is for 2025. They're looking at net sales growth of about 2.8% next year. So these are the midpoints of the guidance. Comparable sales growth up about 1.0% next year. In terms of EPS and profitability, they're essentially estimating flat earnings in 2025, actually decline in the low middle digits. Now, when we look at this in terms of valuation, based on the 2025 guidance or the midpoint of that guidance, 25 times is essentially what the stock is trading at right now. But if we look at the 5-year historical on it, Home Depot is really traded closer into the low 20s. So not substantially above the historical, but certainly above the historical and meaningfully so. Now, our take on Home Depot, so the largest home retailer in the world, this does give it an advantage, particularly in a scenario of rising input costs from tariffs, maybe some macroeconomic contraction. It gives them an advantage relative to other retailers because they have that significant cost advantage, that diversification in order to deal with some of these other negative headwinds. Also consistent profitability and a good dividend profile. Prudent leverage, so 2.4 net debt to EBITDA. They're sitting on a strong financial foundation. I'm going to expect that the free cash flow is going to continue. There's going to be buybacks. There's going to continue to be dividend increases. But when we look at that valuation, trading at 25 times forward earnings compared to the historical in the 20 to 22 times range, given the fact that, we're in an environment here that whereby the uncertainty is much higher than what we've seen over the last 5 years, I would say, for the most part. I mean, obviously, there's been times like COVID, other times over previous years where there was a lot of uncertainty. But certainly with the tariffs, a lot of the macroeconomic headwinds, we've seen some contraction in consumer spending and consumer confidence. A lot of this really comes together to say this is not an ideal, rosy operating economic environment for the company. So I would not expect for them to trade at a premium multiple in that type of environment. And then the risks, of course, as I had said, all the tariff uncertainty, the interest rate headwinds. So we don't see any value in the stock currently. It's not a company that we would buy at the current valuation. Long term, I think that it's going to continue to be a leader in the space. Home renovation isn't going anywhere. I think they're going to continue to be profitable, depending, of course, on what happens with their input costs. But it's not a company where I see any value in the near term. Certainly, I would want to buy it at a discount to its historical right now. If it were trading in the 15 to 20 times price to earnings range, then it starts to look interesting. But at even a moderate premium to the historical valuation, it doesn't really interest me that much. But we'll keep an eye on it, and if there's an opportunity, certainly we would pounce.
Yeah. I've got construction going on right now outside, so it's kind of like a nice little segue. Not that my segment will have anything to do with that, but one thing, I was in Home Depot last weekend buying a couple pails, and I noticed when I was checking out, it was all self-checkout, and there was just one lady who would come around and help you, do the checkout. I don't know if when you guys were just there, if that was the case in Vancouver's Home Depot. Ryan, you were saying that you were just there.
Yeah, basically, there's one person there and they'll help you, but a lot of it was self-checkout.
Yeah,
So
self-checkout.
there is a push towards that, and less employees potentially in the store, or maybe they have employees helping you around there. But they're certainly at the checkout. We're going towards self-serve for sure, which is interesting and potentially helps margins. Maybe that's a way they're able to gain some on the profit side, and then the tariffs that you could lose some on that. So that may be a way offsetting that. I'm not sure going forward, but I think, Aaron, the summary there is if you're looking at premium valuations in a more uncertain environment, it's probably just a whole, you hold on and you're not buying more or buying any at this point. You're waiting till you could get maybe a good company, but more of particularly when you're facing uncertain times, I'd probably want a more discounted multiple. I think that's what you're saying, right, Aaron? I believe.
Yeah.
That's basically, that's a good company. But yeah, when you're not buying it in an ideal scenario, then obviously you want to pay a little bit less. And I don't see that. I don't think that, and I think this is in a lot of stocks. I just don't think all of the risks are really
recent commentary over the weekend out of some of the big bank heads saying just the markets look complacent right now after the drop and then the pop back up. There are significant headwinds facing the market, so I'm not sure how a bounce right to almost where we were or slightly higher than where we were ahead of all this tariff noise is justifiable. The backward looking nature of Q1, like we did not see, you're not really seeing any tariff effects in there. You're going to start to see that in the next quarterly announcements. It kind of ceases to amaze me, or it doesn't cease to amaze me, how surprised the market can be when you're getting punched in the face saying that, you're going to have weaker quarters coming up, and then the weaker quarter hits and it's like, So maybe the market will be surprised. It shouldn't be surprised that there's going to be a hell of a lot of noise in these numbers, I would think. There's even going to be some on the positive side where companies bought from a supplier, and that supplier is going to do more to stuff their inventory, and it's going to look like a gain in that quarter. It may look like to an investor a sustainable gain. I just think there's going to be a lot of strange one-time type items, and then there's likely just a freeze up in spending that's going to affect over the next several quarters until we can get some certainty and people can start to deploy on projects. So yeah.
I wonder too, sorry, I was just going to, on that note, just as you were saying there, 9.4% growth in revenue. I'm wondering as well, how much of that is coming as well from people who are like, they're expecting that prices are going to increase. They know they have a reno coming up. So there
had to be some of that,
a lot of their stuff. And it's like, maybe this is the Q1s are actually the good quarters, right? For some of these companies, and then you're going to start to see it.
Yeah, there had to be some. Depending on what, if you were looking for a car, people may have went out and said, "Oh God, these are all going to get tariffed." I know I'm going to buy one in the next 3 months. I'm sure some people were pushed into buying a vehicle, near term ahead of that. If you thought there was going to be a 10, 25% tariff, you were going to react. I saw dealerships putting on, we're still no tariffs, or there's no tariff. Get our no tariff inventory, like those things were out there. So people may have been pushed into that, and that may have drawn some sales backwards into that quarter from where they naturally would have came over the course of the year. All right, well, let's move on to Brennan's honest opinion on Jessica Alba. No, wait, on the honest company. Why do we keep revisiting this company, Brennan?
Just because of Jessica Alba.
Yeah, I knew it. We knew it.
Yeah. And again, I apologize. Hopefully the construction outside isn't loud. So let's
honestly, we don't hear it.
Well, that's good. That's good. Honestly.
That's terrible.
Honestly, that's great. So yes, the honest company, HNST on the NASDAQ, currently trading at a price of about $5.42, market cap of $607 million. And they are a personal care company dedicated to creating clean and sustainably designed products. Its products include baby clothing, diapers, wipes, nursery products, skincare, and makeup. And like Ryan said, the company was co-founded by actress Jessica Alba and IPO'd at $16 per share in 2021, raising over $400 million. And I included the 2023 breakdown of revenue by products to give listeners a general sense of the breakdown, as unfortunately in their May 2025 presentation, they do not include an updated pie chart. So they aren't being so honest there. So since its IPO in 2021, the stock has really been in free fall, as the company has been unable to generate any profitability or sustainable cash flow. But when I covered the stock last, It was up significantly, driven by the company's strong Q3 2024 results. And I covered it last in November of 2024 while it traded at about $7.30. However, the stock price has tapered off back below $6 per share. So let's get an update on the business overall. When we looked at the long-term financials last time, since 2019, we could see that revenue was growing with a compound annual growth rate of about 10%. And while operating and net income was still negative, it was trending in the right direction, especially adjusted EBITDA had become positive. Now, looking at the recent quarter of Q1 2025, revenue increased 13% to $97 million and was driven by strength in baby products and its wipe portfolio. Gross margin increased 170 basis points to 38.7%, driven by product and supply chain cost savings. Adjusted EBITDA was positive $7 million compared to $3 million for the same period last year. And this represents the company's sixth consecutive quarter of positive adjusted EBITDA. If you're looking up at the screen right now, this is just including Q4 of 2024. It doesn't show the Q1 of 2025. Now, net income was a gain of $3.2 million compared to a loss of $1.4 million for the same period last year. So, like I concluded last time, it appears the profitability is continuing to trend in the right direction, which is good to see. Now, the company was able to achieve its fiscal year 2024 guidance with revenue growing in the high single-digit range, coming in at 10% for the year, and adjusted EBITDA exceeded the high end of management's $20 to $22 million target range, coming in at $26 million in adjusted EBITDA. Now, looking towards fiscal year 2025, the company is only guiding toward mid-single-digit revenue growth, and adjusted EBITDA is expected to be up about 10%. So growth in revenue is expected to moderate to some degree compared to the growth in 2024. And in November, when I covered the stock, based off of its 2024 forward guidance, it was trading at about 31 times forward enterprise value to EBITDA. Again, the stock, I think, was about $7.30 then. But now, using its 2025 guidance, it trades closer to about 19 times. And on a price to cash flow basis over the 12 trailing month period, cash flow has gone negative. So we unfortunately cannot get a gauge on the valuation when it comes to cash flow. And the same can be said about the trailing price to earnings multiple, as net income over the last 12 trailing months is negative. Now, looking at the balance sheet, it remains quite healthy with cash of $72.8 million, no debt, it just has leases, and a net cash position of $61.8 million. But we can see that the company's share count continues to creep up. As last time I covered the stock, it was at about 100 million shares outstanding, but is now up to 110 million shares, or about 115 million shares fully diluted. The company continues to be in its strengthen phase, but management indicates there is scalable growth opportunities by increasing its distribution points from 45,000 doors selling at the end of 2024, with 65,000 remaining doors available for the company to tap into. They also believe that they have an opportunity for larger presence on the shelf, with competitors possessing over triple the average products on shelf per store compared to Honest. So to conclude here, the Honest Company is in a highly competitive markets with over 60% of its revenue coming from diapers and wipes. But like I said last time, these are more consumer staples, which are a bit more defensive. The company has a good track record of producing high single-digit revenue growth, growing with a compound annual growth rate of 10% from 2019 to 2024. And the business has increased margins now with 6 consecutive quarters of positive adjusted EBITDA, but revenue growth is moderating in 2025. The balance sheet remains healthy with net cash per share of about 56 cents per share. And the stock's valuation is better than we covered it in November of 2024, down to 19 times forward EBITDA from 30 times forward EBITDA. But revenue growth is expected in the mid-single digit range, with EBITDA growth expected to be around 10% at the midpoint. So right now, I think that the business is trading closer to fair value, or at least isn't screaming value at this point. if revenue was expected to grow in the mid-teen percentage range along with EBITDA, it may be 20%, something along those lines, I think that it would then be more appealing. But overall, I don't think it's a bad business, and it does check off a lot of boxes for our investment criteria. Cash-rich balance sheet, getting into profitability, a runway of growth. But I continue to think the business is a little early for us, as we would like to see, continued ability to massage those margins higher and generate more meaningful profitability and get into, sustainable cash flow or positive cash flow. Keep in mind as well, they only did adjusted EBITDA margin of 7% in fiscal year 2024, and the business is expected to be at approximately 7% adjusted EBITDA margin at the midpoint in fiscal year 2025 as well. So keeping that in mind, it's not a high margin business by any means. So I can understand why the stock has pulled back since we last covered it, as it was projecting better growth in 2024, along with more of an inflection in margins due to its cost savings initiatives. But right now, I think it's just closer to fair value, and we will continue to monitor the business. Any comments, guys? Absolutely.
No, I was waiting for Ryan to unmute.
Honestly, not a ton of comments on that one.
Honestly, that's fair.
Yeah, no, it's. I mean, it's a good summary of the business, and and we know why we reviewed it, right? So.
I think that if you got something, don't worry.
Yeah, go on.
Okay, good.
So just on them being impacted by tariffs, like we have to talk about everything right now. Their diapers are USMCA compliant, and they're from Mexico, so they're fine there. But then their wipes on the other side are from China, so they're impacted there. So right now, doing a bit better than what they were a couple of weeks ago with a rate dropping, but obviously that changes as we've repeated. I don't know how many times at this point. So
honestly, I don't know.
Honestly, we don't know how many times we've said that, or how many times we've said honestly. Mm-hmm. But that will further impact their margins, and that's what Brendan's really focused on with this company. Is the margins are not that big; they're small. Yeah. It's pretty interchangeable. If diapers do go up in price, you're probably going to just switch out for another brand if you need to. Mm-hmm. And it's really hard to get those big margins, which is what my concern would be over the really long term for the company is, can they actually expand their margins enough to support a 19, 20 times EV EBITDA like they are now, in which I don't think it really deserves that multiple at this time with the margins it has, no. I would say.
No, honestly, I don't think so long term.
And honestly, I thought that was a great comment, Brett. And honestly, I think we should move on to Brett's segment.
Let's put that one to bed, thankfully. All right, let's go. We're going to look at SolarEdge Technologies. This, again, was a dog of the week in late 2024. It cratered from its highs. The stock has kind of dead cat bounced to start this year. Maybe it is more sustainable, but Brett's going to try to let you know right now.
Yeah, so like Ryan said, last time we looked at SolarEdge, it was in late 2024 as a dog of a week. I think we've looked at it a couple of times, though, and as well looked at it in some of our reports for our clients within, I think, a couple of special reports. But the stock really collapsed due to poor financial performance. Its gross margins went negative. There was massive inventory glut in Europe and within the company itself, and it was driven by really Chinese competition as well as just a globally weak solar market as a whole. And then that resulted in a big write-down in inventory last year. So really, what's happened since then? Has it actually improved? Are we going to see some degree of a turnaround? What is going on? So a quick description of the company, if you don't know what it is. SolarEdge specializes in creating direct and current optimized inverter systems for solar photovoltaic applications. Their offerings include power optimizers, inverters, and a cloud-driven monitoring platform catering to various solar market segments, so household, commercial. This includes everything from that small-scale residential solar project to commercial and smaller utility-scale solar deployments. The stock has had a strong performance in 2025, up 41% year-to-date to $20.89 a share at the time of recording. However, this is still just a tiny fraction from its highs in 2023 or before the 2023 drop. It was trading at high $200, low $300 range. So you're down still 90+% since that heightened valuation during that time. So is the 2025 recovery built on sustainable growth? Are we actually going to see a proper turnaround, or is it just a dead cat bounce? What is going on? So looking at this Q1 2025 numbers, revenue saw a slight growth year over year of 7% to 219 million. Good to see it's not declining, but it's not the biggest growth what you would really hope for in a turnaround story at the time. However, more importantly, the gross margins are once again positive. Positive gross margins, that is something to celebrate, and they are at 8% on a GAAP basis. Obviously, still not great margins for a long-term business. That's not sustainable for a long-term business, especially we're just talking gross margins, not even net income margins, but it's at least a shift in the right direction from those significant made negative margins. Mind you, in Q3 last year, if you are looking at it, that was because they had a significant write-down. It was still poor, don't get me wrong, but it wasn't as poor as it appears to be on the surface. It was an accounting number shift. So prior to that major decline in 23 and the write-down, a more normalized margin for the business was in the low 30s%, just for a point of comparison. So if you are looking for them to work back up to what they were prior to the collapse, look into that 30% range if you are expecting that. And as gross margins are just so slim, it's no surprise that the company continues its net loss streak at a loss of 98.5 million or $1.70 share loss. The balance sheet still remains relatively strong, as it had a massive net cash position prior to really the market decline, but it has since fallen to 113 million in net cash, which is positive. That's still good, especially considering the market cap itself has declined significantly. And the company expects to be able to now pay its 2025 convertible debt as it comes due later this year. That was a concern by many investors and skeptics of the company, is are they even going to be able to remain solvent? Which at this time, that doesn't seem to be concerned. They are expecting now to be able to have free cash flow break even, which I'll get into in a minute. But overall, it seems to be fine, at least for cash flow for 2025. But the company still does have a massive inventory balance of 637 million, about half its market cap, slightly lower sequentially, which is a positive to see a decline in those inventory levels, as is that is something they need to work through over time, and they have been working through. So good to see, but it still remains just way too high at this time. So moving to the guidance, for Q2 management guidance, revenue between 265 to 285 million, non-GAAP gross margin between 8 and 12%, which includes a 2% negative impact from tariffs. As well, I will note this was before the lowering of the Chinese tariffs from that 145%. So likely they're going to have a bit less of an impact during the quarter, but we'll see how that shakes out. And that was also net of some price increases. And the company expects non-GAAP operating expense of 90 to 95 million. Putting this all together, non-GAAP operating losses will still be in that $60 million range. So still significantly unprofitable. As well, for the full year, the company now expects to be free cash flow break even. This is actually lower expectations from prior expectations of being free cash flow positive. The shift being due to those tariffs. So we'll see how that shakes out now that we've seen a further change since their quarter's end. But a large part of this working capital or free cash flow break even is due to working capital management relating through that work through of surplus inventory, as well as accounts receivable and so on. So we'll see if they are able to bring that more in line with really levels that can actually support the business and not be a hindrance on the business. And as well, as it was really a focus of the company prior, and really what we need to look through going forward, as it really has been headwinds for the company, is this European operations. The management believes inventory in Europe should start to really normalize by the end of Q2. The company has been providing discounts in the market to regain some market share, as they lost significant market share during that decline. And once the inventory levels are normalized, they believe they will be able to reduce some levels, the level of support, so discounts to their distributors, which will be a good thing for their gross profit margins. But overall, the European market is still expected to decline year over year. But they have seen that shift in the terms of their own market share. So they are being positive when it comes to themselves, but not really a bit of a less negative, I guess, sentiment towards the European market as a whole, but still generally negative. Prior to the collapse in 2023, Europe really was the company's biggest market, but in this last quarter, it was only 24% of revenue, just to give you a size of the shift. So, but a shift in the European market going forward could be a major catalyst for recovery for SolarEdge. But just as a note, Europe did have an energy crisis during the 2023 time period. So there was massive, really above average demand during that period. So without the massive supply influx, demand will likely not be the same as it was during that period. But a middle ground should be more obtainable, because right now we're just seeing really the negative side. 2023, 2022, we saw that massive over demand environment due to the energy crisis in the continent. Valuation wise, we don't really have much to go on as the company isn't profitable, not the greatest metric, but is that trading at 1.3 times price to sales, which is cheap, but that's for obvious reasons as such low margins at this time. But it is discounted reasonably because of that weakness. But looking forward, which is the more interesting thing, because it is really trying to become a turnaround story as far as holders of the company would hope, at least. That seems to be fine at the current levels, with the repayment of the 2025 notes being manageable under the current cash and marketable securities position. The next repayment for its note isn't until 2029, so solvency risk is really off the table, and I would say it's relatively low of concern unless something major happens between the repayment, giving the company some time to recover until that 2029 repayment. If the company can remain free cash flow, break even, or positive, they'd be fine in that scenario as well, as they are overall in net cash position. Of course, there is no guarantee that the company can remain in a free cash flow or break even or positive position, but for 2025, that's what they're guiding. Long term, we do need to see a shift back to that positive free cash flow to create any real value for shareholders, though, and not just really pushing down on that working capital. We do need to see actual earnings profitability as well. Tariffs, while negative for the company, probably won't be the make or break factor for the company, as they did have some Chinese supply chain, but they are not. It's a bit less than what the market was really expecting, with that 2% on the higher tariffs, and the tariffs have been obviously pulled back a bit since then. The company does have U.S. production, which avoids a degree of tariffs, and has been ramping up production within the country. The company has capacity for 70,000 inverters per quarter within the U.S. at this time. Further, like most companies, SolarEdge is looking to further diversify its supply chain to avoid tariffs. As well, they've actually had a bit of a tailwind over the past couple weeks, as the 45X tax credit for renewable energy infrastructure seems to be intact in the U.S. There was the question about, was that going to be cut out of the budget? And at this time, it seems it hasn't went through, I believe, the House in the U.S. at this time, but it's at least in the current budget. So that is a good tailwind, because there was quite a bit of skepticism if that was going to be removed, which would have dampened the solar industry in the U.S. and renewable industry in the U.S. as a whole. So overall, benefit for SolarEdge with that looking to be intact. So for investors, is this a turning point? Maybe prospects have improved, but this is not a confirmed turnaround by any means. Gross margin has improved, but it's still far, far away from that high enough level to be a net profitable business, especially over the long term. Further economies of scale is still just lacking. Sales are low. Q2 guidance does imply some sequential growth as well as year-over-year growth, but not at the levels needed for long-term profitability. So for now, we are nowhere near a buy or anything like that, but we will continue to monitor the company for turnaround potential. And for disclosure, we have no relationship or positions in the company.
Yeah, it's a good summary. We just, we monitor companies like this. If we don't have existing current profitability and significant cash flow, it's not a company that we can invest in. But it gives you an idea of, the countless number of companies that we are evaluating, looking at on a daily, annual, monthly basis. It's a company that we continue to monitor, but it wouldn't meet our criteria right now.
Yeah, these
Imagine. Go ahead.
Brett. Oh, okay. I'll go ahead.
Canadian standoff.
Yeah, Canadians. But yeah, the thing about these turnaround companies is we don't like them in the early innings. We need them to be at the 6th, 7th, 8th inning before we can even consider it. This is very, very early on in what would be a turnaround. And many of these turnaround stories do fall apart more often than not by far. Yeah. 9 out of 10 fall apart, or they just stay in this zombie corporate mode for years and years. And you don't want to hold that either as an investor. You want something that actually creates value. And that's what I was really wanting to get to with that free cash flow just being break even. Over the long term, you do need to see a positive to create actual shareholder value. You might see some fluctuations like we have seen with the valuation really doubling since it's low, but it's not sustainable. Those are on the speculative upsides, which I went through here.
Yeah, and all I was going to say is just, how grim the stock price would have got if this was a company that had, maybe a net debt position of 200 million or something like that, rather than a net cash position. Again, it's just, pounding that into listeners' heads.
A good balance sheet helps, without a doubt.
A good balance sheet helps as a bottom in the stock for sure.
Yeah, I forget what it was during its peak, but it was, I think, 1.5 billion or something. Just to, like, they have drawn down. It might have even been more than that. Was significant, a net cash position.
Yeah. All right. Well, I think that will close out our show for this week. If you are watching this on YouTube, remember to smash that subscribe button. If you're listening to this wherever you consume your podcast, rate and review us, and keep your questions coming in for our Your Stock, Our Take segment, and we'll answer those on a weekly basis. And as always, I'd like to wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.